Hi, and welcome to Midas Investing. Today we're going to be taking a look at Baytex Energy, ticker BTE. This company, which is headquartered in Canada, but also dual listed on American exchanges, is an oil and gas exploration and production company. I've been very interested in taking a look at the energy sector, what with the decline in oil and gas prices over the last year. Though I will say my interest in Baytex specifically happened through a little bit of a roundabout way. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. I began my process by screening through a variety of companies in the energy sector in jurisdictions that I approve of, and then screening them even further by specific metrics that matter to me, and then correlating them also against oil to determine which companies that I thought were most underpriced relative to the oil prices themselves. I analyzed my sample against perceived cheapness, both in terms of forward earnings as well as forward revenues, as well as against their current liabilities ratio to determine which companies that I thought were basically the cheapest in terms of oil, as well as their earnings, while also having relatively low liabilities. And I ended up with Baytex as the one to take a look at. If you're interested in learning more about the process that I use here, as well as how that relates to the oil prices that I'll be using later, you can watch the live stream where I discuss this process in detail. So taking a look at Baytex, you can see the array of properties they have right here on this map, traditionally having a lot of exposure, particularly in heavy oil in Canada, as well as natural gas in their Duvernay and Peace River Peavine properties, as well as Lloydminster. They also then, over the last several years, expanded some of their properties further into lighter oils, as well as natural gas liquids, as well as expanding also into the Eagerford properties in Texas. They recently, within the last quarter, also made an acquisition of further properties in the Eagleford area, as well as their acquisition that they've done recently of their Viking area. So continuing to expand their total exposures, as well as branching out across the various commodities by type. As you can see here, pretty significant exposure to heavy oil still, though this used to make up more of a lion's share of their total business. And then they've rather expanded their total light oil exposures while having still significant chunks with alternative gases as well. One other thing that's worth noting is with the recent acquisition, they also announced a new dividend. So it's going to be 9 cents per share on on an annual basis, which is going to be a little bit less than 2% off of the current share price. One thing that's going to make this valuation very difficult to make accurately, I think, is assessing the total production levels that they're going to have over a longer period of time. They provide guidance for their production levels at the close of their acquisition that they recently done for the second half of this year, this being on a per day basis, and also showing the relative levels of liquids versus gases. And they also talk here about how once they get their leverage levels back down to their target levels, they are going to be expanding their distributions to shareholders through the dividend we already discussed, as well as share buybacks. Which is nice. But like I said, making projections for the company based off of the production guidance is tricky, partially because of, like I said, the acquisition that they made and how this relates to their past productions. I'm going to be making my model based off of the past production numbers and how those production numbers have come down over time, because largely they have developed resources, and then the production levels tend to slowly diminish over time as they kind of manage the decline of those assets. So basically they have a certain asset base, and then those production levels are going to slowly come down over time. And really it's making an estimate of how slowly those production levels are going to come down over time relative to the reserves is how we're going to make our projections. And then, like I said, I'm going to try to make as best of an adjustment for the recent acquisitions as I can. We'll get to that when we get to the model. One other thing that's going to make this a little bit difficult to model, which relates to something I was just talking about, is just the kind of perpetual decline of these oil wells. As you can see right here, that in general, these are very, very highly profitable upfront profitability type wells that tend to fall off very, very quickly. So you have very, very high IRRs for the individual wells. So they pay off very, very quickly, anywhere between 6 months to 2 years, depending on the well, depending on the location. You could argue some of these numbers are a little bit beefy as well, having IRRs up over 100%, and which means that the payout is going to be in a very, very short period of time. But if you look into the general economics surrounding these types of oil wells, they also tend to evaporate relatively quickly. It might only be a few years of life, and it might also be relatively fast that suddenly they stop producing. It's not necessarily going to be something where you have a lot of signs that those are starting to diminish very quickly. So the point is, we're going to be very conservative in our estimates about our projections for the production levels of this company. But I'll be fully honest that there is a whole lot of uncertainty surrounding this, and so I'm doing my best to, base off of the locations and based off of the type of product at each of the locations, I'm going to try to make my best estimates of where the production is going to go over time. But it's going to be a crapshoot either way. Now, I mentioned a moment ago that they currently have a cash distribution plan set up that they're going to be putting about 50% of their free cash flow towards balance sheet improvement, while 50% of it's going to be returned to shareholders. And this is currently their target set up for while their total debt is above 1.5 billion. But they do actually have a forecasted plan in place so that once they get their debt below their target level of 1.5 billion, then they will start to actually distribute about 75% of it to shareholders and only 25% of it towards debt and other balance sheet improvements. So there is a further capital allocation a plan in favor of shareholders for the future. Now, they also have this slide on here talking about their free cash flow sensitivity relative to oil prices. Right here, they show the sensitivity on a table showing oil prices at WTI US $70 per barrel up to $80 versus $90, showing their free cash flow yield against the market cap going from 16% up to 37% accordingly, with the free cash flow number here in the millions on this side. I did compare my own projections in my valuation accordingly against this and found in general to be pretty consistent with it. While I think in general, I'm going to be maybe leaning a little bit more towards a more moderate end of this scale in terms of the x-axis here. The actual way it scales up to the free cash flow against each of these percentages against the oil prices is pretty about accurate. So I think my own projections for a free cash flow against different oil prices seems to be relatively consistent with theirs, and so does the actual levels of the free cash flow allocated to shareholders accordingly with what we would call free cash flow to equity. It seems to be relatively consistent as well. One other thing that's relevant to oil prices as well is discussing the fact that they actually have a pretty strong risk management approach, in my opinion. They have a pretty thorough approach to layering on collars and puts against crude oil volumes projected out for the next 4 quarters, having puts against for the first 2 quarters, and then a collar providing floors and ceilings against the oil prices, saying for basically the next 2 quarters that they are relatively certain that oil prices aren't necessarily going to go too much above 100 prices, $100 per barrel, but they also do want to have a floor against that at $60 per barrel, which means that they're going to have profits between $60 to $100 per barrel, even if it goes below $60 a barrel in the short run. So people who are concerned about oil prices dropping in the short run, I would point out that Baytex is actually well protected accordingly to that. Though it's worth noting that means that if it goes above $100 per barrel, they would also be losing out on upside. So protection isn't free. And now, if we're going to do a valuation of an energy company, we need to have some sort of perspective on where energy prices are going. So I've worked a lot behind the scenes, where you can watch my live streams where I discuss that, as I already mentioned before. I have put together a model for projecting out oil prices as well as natural gas prices. We'll talk about oil prices first. My oil price model, I built a projection regressing factors, including the global population, US M2 money supply, US productivity growth, as well as the S&P 500 market value. And using those factors, I can project out an expectation for oil prices 10 years in the future with at least moderate confidence for my range of prediction. And specifically, I'm predicting that at least 50% of oil price values would fall between $109 per barrel and about $42 per barrel, with the midpoint being about $75 to $76 per barrel. Now, this is just my own model. Obviously, this is one person's estimate of it. I compared my estimates also against many other estimates made by various organizations, including the World Bank, the IEA, the National Energy Board, McKinsey Institute, as well as Deloitte and Touche. And then I composited all of their estimates with my estimates and built a distribution of oil prices that you can see here. So with that, we have the 80th percentile at perhaps around $105 per barrel, with the 20th percentile maybe about $65 per barrel, the median being about $75 to $76 per barrel, expected value being about $79 to $80 per barrel. So this is the range and the distribution effectively that I'm going to be using for projections in my model of oil prices. And I took basically the same approach with natural gas prices. Unfortunately, I was not able to get even up to reasonably moderate confidence levels for the model that I created. So I did handicap the values that I came up with, and I ended up with an expected value for natural gas of about $3.60 in 2032, with an upper range of about $7.44 and a lower range of about $1.68. And unfortunately, I didn't put together a solid composite of other estimates like I did with oil prices. But like I said, I did handicap it accordingly, so I felt like I could just rely on those estimates. So coming over to take a look at the model that I built for them, first we'll take a look at some charts of their production versus their reserves. This first chart here, the bars, we have their production numbers by the commodity type. In the blue, we have the light and medium oil versus red. We have heavy oil, natural gas we have in the gold, and then natural gas liquids we have in the green. Each of these are in their appropriate measure, so the size of the bars relative to each other isn't really relevant. It's really just more about how the bars themselves change relative to themselves over time. Just so that's clear, these are in different metrics, technically speaking. So just compare the gold with the gold and the green with the green, and so on and so forth. But the lines themselves are actually the amount of years that are left over of this production at that current production level relative to the reserves. And on the next chart, we'll be showing the reserves with the same line so you can compare between the two. But the point I'm trying to show here with these is that for light and medium oils, you can see that the production levels, and this is a per day production level, just so that it's clear, over time has come down over the years, in particular for light and medium oil. For heavy oils, it was coming down a little bit up to 2020, and then since 2020, it's come up a little bit, and so 2022 is still is technically a little bit higher than what it was in 2018. For natural gas, you can see another downward trend like it was with the light to medium oils, and then likewise, natural gas liquids, a little bit of a downward trend like it was with light and medium, as well as natural gas. So in general, a downward trend in the production numbers for each of these commodity groups, except for the heavy oil, that being the exception there. And then likewise, if you look at the amount of years that is left over relative to the reserves for each of these categories, starting with the light and medium oil, in general, this has been coming upwards, not upward at a very fast pace, but this is technically moving upwards relatively consistently. Heavy oils, it has come downwards, which I would point out that that's the heavy oils, which is the one where the production numbers were starting to come up. So production numbers for heavy oils comes up, but the amount of years that are left over of it starts to come down. And then for natural gas, the production numbers were coming down here, while the amount of years, it actually came upward a little bit initially and then came down, but overall it's slightly up from where it was in 2018. So another downward trend in production with an upward trend in the years. And then last but not least, with the natural gas liquids, we likewise saw a downward trend in production with an upward trend in the years. So now if we switch over to the reserves, and as I had said before, the lines are going to be exactly the same, still basically just the years, but now we have the reserves for the bars. And likewise, like I said, it's a slightly different unit. So really it's just comparing each color against itself. And then for here, we also technically have a 2023 estimate for the reserves, adjusting for the recent Ranger acquisition in the Eagleford area. So this gives an idea of like where the reserves popped up to after adjusting for the new assets we acquired. So likewise, we can see somewhat of a similar trend where the light and medium oil, it was actually moving downwards. So the reserves were moving downwards, and the production was also moving downwards for the light and medium oil. And then nonetheless, we see the actual years moving upwards on a trend with that. The oil, the heavy oil, we see a little bit of a downward trend as well. However, like we said, we saw the production numbers moving upward for the heavy oil, so the years are actually moving down anyway. Natural gas, we can see a pretty consistent downward trend in the total reserve numbers through 2020. That's pretty much what we're pointing out, through 2022, not through 2023. And then likewise, what we were talking about, we see a slight upward bump in the total reserve numbers, and then natural gas liquids, a downward trend in the total reserve numbers through 2022, and an upward trend for the years. So the point I'm trying to show here is that yes, production levels have been coming down consistently over these years, while reserves have been coming down for most of the categories. But the point is, it's a very well managed decline because the production levels are coming down at a faster rate, which means that they have been pushing up the actual sustainable lifetime of their total operation. And that's prior to the acquisition, because then if you adjust for the acquisition, what you'll see here is that we get a huge bump up about, it's on average for each of these categories, about 60% bump up in total reserves. So about a 60% bump up in light medium reserves, a 60% almost, this one's a little bit lower, bump up maybe like 50%, bump up in natural gas reserves, and then also likewise a pretty significant bump up in the natural gas liquids reserves. Which category do we not see a bump up in? the heavy oil. So heavy oil seems to be the category where we can actually expect to be seeing further declines. Likewise, they're not making any strategic moves to bolster that area. They've actually allowed the production to continue to increase, basically like they're just running it off. And then likewise, in the other three categories, we see them actually bolstering up the reserve levels, which as far as I'm concerned gives them optionality. They could continue at the production levels they were previously at and have extended out the total lifeline of their operation by a much larger factor, or they can actually increase the total production levels and therefore increase the short-term cash flows to the shareholders based on that. So as far as I'm concerned, both their managed decline of the production levels as well as the recent acquisition puts them into a position for the next decade to essentially choose which production levels is best suits their needs at any given moment. So coming over to take a look at the model that I built, as I was kind of just showing on those charts, we don't really have a whole lot of data in like form, depending on the specific assets and locations, going back much further than 2019 and 2018. So unfortunately, that's kind of just the basis of this model that I have, even though I have like revenues and oil numbers going back much further than that. But the point is, either way, that's kind of what we're showing here. As I had already talked about, we have our expectations for oil prices here at the top, and then I have my expectations for natural gas prices here as well. I didn't have a projection for natural gas liquids, unfortunately, because there's just not as many years in order to build a model to regress off of. So really, I just made my natural gas price expectations based off of the relative ratios between natural gas liquids and the Henry Hub, as well as the natural gas liquids and the oil price itself. And so I just kind of took a general average between those and then arrived at these prices here. But then likewise, like I said, we're mostly just kind of putting a little bit of a crapshoot as far as our expectations as for the production based off of just the trends I was just showing in the charts right there. And then while I do have it split off into the different commodity types by heavy, light, natural gas liquids, and natural gas themselves, I did also split them up by their location, that being Canada versus US, because they've been largely expanding more in the US and acquiring more in the US as part of their kind of strategic shift across the different asset types. So likewise, the point is we saw a little bit of an increase in production in heavy in Canada, and I don't really see that increase likely to sustain. As we were talking about, they're going to be burning through the reserves a bit. So I'm seeing that maybe in the bull case they can continue that increase, but in the bear case it's likely to reverse, and then in between it gets kind of halfway as an average. The light in Canada, likewise, we saw massive decreases over the last several years. And as I was just kind of showing, based off the fact that they've bolstered their assets, I don't see the decrease as needing to be nearly as much moving forward, though perhaps it will still be a decrease just because of just the way that they're managing the overall process. So I'm just kind of varying the decrease to be significantly less than it was previously. Similarly, the natural gas liquids in Canada had huge increases over the last few years, and I similarly don't see it as sustaining in quite the same level of pace, though it is still a pretty viable alternative relative to oils and natural gas in general. So I still see increases as possible, especially given the acquisitions that they made. So I'm seeing just lower increases for their generally across the board. Natural gas, we saw moderate increases in Canada, and similarly to with the heavy, I'm essentially assuming that maybe it could sustain similar increases in the future, but in general, I'm seeing possible potentials for it to actually reverse, and also maybe somewhere in between across the board there. In the US, for the light oils, we had relatively larger decreases in production for the last several years, and similarly to the reversals that we saw in Canada, in this model, I'm seeing that maybe it will be decreases as well, but probably significantly less decreases over the coming years. And then natural gas liquids, it's basically the same story, but scaled up a little bit. So probably still decreases, but probably at a much slower scale. And then similarly with natural gas as well, decreases probably much less so. And then it's worth noting for all of these categories, these are all based off of the production numbers that they showed right here, the growth rates. But then I adjust after using the growth rates themselves for the increase in assets made by the Ranger acquisitions that we were talking about. So then each of these production numbers had then been boosted by the approximate 40 to 60% increase in total assets to get to the total production numbers that we're expecting. So nonetheless, if you add them all up and convert all the units accordingly, because a lot of these are in different units, and so you do have to do a lot of conversions to get them all in place. But accounting for production in terms of barrel oil equivalents per day, this is the numbers that we end up projecting for 2032, which is anywhere between 81,000 to 124,000 barrel oil equivalents per day of production for Baytex Energy. Now, it's worth noting that in 2022, they had 83,000 in change, and that this is not adjusting for the acquisition. So if you were to take into account the amount of decline they had over the previous several years prior to that, they themselves had had production declines of almost 3% per year for the last several years. And so really, I'm actually saying that production is going to increase by about 2% per year, but that's because they had the acquisition. If you adjust the previous number for the acquisition levels, it actually means that we're projecting from post acquisition pro forma numbers, we're projecting a decline of a little over 1% per year for the next 10 years, which I think is a moderate decrease from the levels before. So it's consistent with the story we're sort of telling for this. So then if you take all those production numbers and then you adjust with the energy prices that we had implied, we end up with anywhere from 1 billion as a bear case revenues in 2032 to possibly 3.7 billion in 2032. Then I took averages also of their blending ratios, their royalty ratios, their operational cost ratios, transportational cost ratios, and their general administration cost ratios, as well as depreciation amortization, to try to make an estimate of where I think operating margins are likely to go over the future. So that's partially where I get my margins for the rest of my projections, which layers into also then, like I said, I made my free cash flow assumptions to be reasonably consistent with the sensitivity assumptions that they had shown in their presentation. So with that, we come over to my valuation template, and you can see right here on the revenue inputs, the expected cases for the short term I have basically in line with analyst estimates, and then moving out into the future, we come up to the bear, base, and bull case estimates, approximately give or take 100 million or so for what we had just shown in the models. Showing on the charts here, you can see the cumulative growth cases. We're seeing essentially a nice spurt in growth initially, which will then lead into declines as those production levels start to be curtailed over time, regardless of the increases in energy prices or otherwise. And likewise, taking a look at the operating margins and incomes in the short run, we have it going in line with the expectations, and then moving towards the model expectations that we had shown in terms of the operating costs. And then in the midterm, I would say it does become a little bit at the higher ends of the profitability, which is what we expect to possibly see when we have a spike in energy prices. And then it'll move towards more of those terminal assumptions that we got from our model. Coming down to take a look at the distribution of operating incomes in the terminal year, we're seeing the bulk of outcomes between about 250 and 500 million or so in operating income, but with some potentialities of it being possibly even double that. Coming to take a look at capital costs and returns on invested capital, that ends up giving us returns on invested capital for the first 5 years, averaging of about 19%, with free cash flows being in the range of about 700 to 800 million on average per year. Then in the next 5 years, we end up having the returns on invested capital starting to drop towards their cost of capital, 13% on average for those 5 years, with the free cash flows themselves being about 500 and change, ending more in the 400 and change level. Right here, you can see the distribution of where those free cash flows end up being in that terminal year. And then coming to take a look at valuation assumptions with terminal multiples, you can see pretty modest assumptions right here. We have the 50% of outcomes, the interquartile range being between $2 per share and $4.50 per share, with the expected value being around $3.36 per share before adjusting for time value. The fair value distribution, as you can see right here, pretty highly skewed. So a lot of outcomes around where it's currently at, with a decent amount of outcomes also decently below, but also lots of skew to the upside. And you can see the expected case valuation right here. The stock currently trading at the 71st percentile of its valuation distribution, about 14% overvalued, expected returns about 9% per year. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's going to do it with Baytex Energy. Very, very interested in this company if it decides to come back down. Unfortunately, pretty much over the time that I analyzed this company, it went from a possibly decent buy to being decently overvalued. So perhaps it can come back down in about the same amount of time. I'll catch you all in the next valuation.